So we move into activity 1 in chapter 15, rollover relief. Remember what I've said about reliefs under this CGT banner. Extremely important for your success. Why? Because the examiner knows that students don't like relief. Yeah, let's roll out the conditions. This one, this introductory question, is reasonably straightforward. Okay, so let's think about rollover relief. We know that rollover relief really involves two assets, okay? And the idea is, in one sense, we're sort of rolling a gain into the purchase cost of the second asset. Now, if you're struggling with this, it doesn't make sense. I'm going to open it up in a minute. But trust me on this. In this particular case, in this particular relief, we're really talking about, a gain in one sense that is deferred. Yeah. In other words, it's delayed because of something that the trader or indeed the company has done. In other words, they've reinvested proceeds. So requirement first, let's look at the requirement here. It says, calculate Graeme's chargeable gains arising in the tax years 2018-19 and 2023-24 after claiming rollover relief where appropriate. Okay. Now, I think broadly speaking, in this sort of learning phase, there's sort of an assumption here that rollover relief is in play. In other words, that the conditions are satisfied. But I'll walk you through the elements of the scenario above, which sort of prove that. Remember, all reliefs across the board in the syllabus are subject to conditions. The revenue are not going to allow taxpayers any sort of advantage without adhering to conditions. So when I think about this requirement, I'm thinking, okay, well, looks like two computations, one in our tax year and one in the years before, and really some easy marks to be had here. We know that CGT is really based broadly, on a basic level, on a three-liner. Proceeds less cost equals gain. Whether or not a relief is in play, we can score some easy marks. Okay, so the scenario. Looks like in September 2018, this individual sold a freehold office block, which he had used in his trade for 1250000. Okay? Now, several things here. That office looks qualifying. That's a qualifying asset. It's a freehold office. In addition, he's used it in his trade. Okay, two key points and two key conditions in relation to rollover relief. Okay, qualifying asset and use in trade. Now, note that the asset had cost $700,000. October 2018 looks to me as if the gain is going to be pretty simple to calculate. Yeah, easy peasy, some easy marks. Now, in July 2018, note a few months before, he sold the freehold office block, he bought a freehold factory, okay, for 1.4 million, which he then sold in October 23 for 1.5 without replacing it. Now, again, from this sentence here, I'm thinking, okay, so just before, okay, I think the conditions are okay, because isn't it for rollover relief 12 months before, 36 months after? There's a 4-year window. Students sometimes find that confusing. How can you get relief on something that you didn't own when you sold the first asset? Well, you can. 12 months before, 36 months after. Freehold factory, I like. Qualifying asset, okay? And he then sold on. So that's the second part of the requirement here. So two gains, okay? So I guess key point is split between, say, simple marks and tricky marks. Tricky marks being obviously the relief itself. So how will we go about this? Well, bottom line is that if we're asked to calculate chargeable gains, I know that in these two sides, both of these tax years, there's going to be three liners. Proceeds less cost equals gain. At least let's get that right, okay? Now, what about the rollover relief? How does this work and what's it all about? Well, as mentioned, we've got to have two qualifying assets, and indeed the other conditions need to be satisfied as well, okay? But it seems to me what's happened here, in effect, is that we're saying that the proceeds, in relation to the sale in September 2018 have effectively been reinvested in another asset, albeit for the fact that the asset was bought before. Yeah, remember, 12 months before, 36 months after. So if that's the case, then the gain, which would be subject to CGT without rollover relief, in effect gets deferred. It gets delayed. What happens with it? Well, the gain gets rolled into the base cost of the second asset. Okay, what's the second asset? Well, it's this one. Okay, so in effect, what we're saying is, okay, rollover relief is in play. You qualify. The transaction qualifies. You know, when you come to sell this second asset, we're going to reduce the cost by the rolled over gain on the first asset. Okay, that's how it works. Now, it'll make a little bit more sense when I show it to you within the answer, but hopefully you've got a feel for what we have to do. Some easy marks and some trickier marks. So let's move down. I've got the answer open and I've studied it. Let's move down just bit by bit, okay? I won't show you that, okay? So the first sale, September 2018, simple enough, yeah? This is our three-liner. We can get these marks all day. Generally speaking, if this is a long form, section C, it would be a half a mark for putting the proceeds in and a half a mark, believe it or not, for just putting the cost in. So that's a mark, yeah, for subtraction, okay? Now, moving down the page, yeah, we see here that they say less rollover relief 550, therefore chargeable gain 0. Why? Well, looking at the scenario and as mentioned, basically, we've got two assets. They're both qualifying. The timescales are okay, and they're in use in the trade. So therefore, this gain on the first asset, yeah, is not chargeable right just now because it is covered by rollover relief. I am deducting an amount, yeah, that basically defers that gain. But where does it go? Yeah, well, if we look down the page, let's have a read of this. It says, first off, so all the proceeds reinvested. Yeah, well, I'll cover that up top. As cost in new factory, 14 or 1.4 million. So complete relief is given. Yeah. Note, if all of the proceeds hadn't been reinvested, okay, then we would have an issue and we have some element of a chargeable gains here. So, for example, if we were in a position where, let's say, you know, instead of this full value of 1250, let's say that the second asset, i.e. here, yeah, was 1.2 million, yeah? So in effect, we'd have a situation where we had 50,000 of the proceeds, yeah, not reinvested, which would mean that the rollover relief was restricted to 500 and there would be 50 here, okay? So that's the first part, some easy marks there. What about the second part, i.e. the second chargeable gain? Well, what was the detail, or what were the details? Well, proceeds, yeah, 1.5 million, easy peasy, okay? There we have it. What was the cost? Well, I know what the cost is, but, okay? The rolled over gain needs to reduce the cost. Yeah, it's a rolled over gain. It's not, you know, eliminated or exempted forever. It's just delayed. It's just deferred. So if I reduce the cost, in effect, what I'm doing is I'm crystallizing that rollover gain at the point of this transaction, this disposal. So therefore, reduced cost equals higher gain. So in effect, as we'll see down here in the narrative, yeah, the two gains in effect crystallize. So the gain comprises the original, yeah, asset number 1, and also the uplift since purchase on asset number 2. So you're basically crystallizing both gains, okay? Now, they do say here, although it's not overly relevant, you know, it could be rolled over again if the proceeds, i.e. 1.5 million, were reinvested in further qualifying business assets. But, you know, on a practical point, I guess that's sort of interesting because you could have an individual who's in business and keeps rolling into new assets if it suits the business model and indeed the plans forward, okay? In effect, keep deferring the CGT. Okay, so there you have it. In summary, not a extremely difficult question, but at least it's taken us through the basic mechanics of rollover relief where we have full proceeds reinvested. Okay, watch for the scenario number 2 where we don't, where not all of the proceeds are invested. And also watch for depreciating assets slightly different. Okay, I hope that made sense. Thanks for listening.